Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Welcome to my podcast. So, Walmart investors were really disappointed because they thought, gee, Walmart did well. After all, they beat their top line and they beat their bottom line. What's wrong with that? And they thought, gee, Walmart should just went up, 5-10%. What a good job they did. But you got to understand, institutions don't care about Walmart beats any of these large companies. That the institutions, and we always follow institutional money. That's what you have to do. You got to follow institutional money. If you don't follow institutional money, you'll never know where the money's going. It's like driving with a blindfold. But institutions, they didn't care about Walmart's beat. They cared about the weak guidance, because see, they know the beats on the top line and on the bottom line are phony. They're rigged. They put them so low so they can beat. They're all phony. They're all rigged. It's the way the industry works. So when they beat the top and bottom line, investors get upset. Say, I don't understand. Well, because institutions, again, could care less about the beat. Because remember, they understand, okay? It's only about guidance. That's all they care about, the guidance, the future. And when the earnings... they don't care anything more than that. That's really it. How's the future look? And when the future looked not good, looked pretty soft, that's why Walmart didn't do well. So bottom line, institutions were disappointed because Walmart's future sucked. That's the bottom line. Now, their quarter didn't suck. The beat didn't suck. The revenue didn't suck. But the future really bad. Their earnings per share guidance, too low. Their revenue growth guidance, too weak. Looking out in the future. Remember, the market's forward-looking. They don't care about the rear. And they always do the same thing. Right before the earnings, they always lower them, and then they go, let's see, we thought it was going to come at 2 cents. Oh, wow, they came in at 4 cents. Wow, bye. And that's how Wall Street works, but most traders don't understand that. They also, remember, they had a lot of weakness, okay, and income, terrible income. And the problem is, the only retail stores that are doing well are the ones who cater to the top 10%. So when you hear good numbers, they're catering to the top 10%. They're the only ones that have money. The bottom half, forget it. They don't have any money. The people that go to Walmart, they don't have any money. So, again, with no money, the bottom 50%, the future looks bleak for Walmart. The top 10% don't go shop Walmart. So, always remember, during earnings season, they always rig the beats. They drop them lower and lower and lower so they can beat them handily. And then the jibber-jabbers can go on TV and say, wow, did you see Walmart? It beat both the top and line revenue. Buy. But it's all phony. But see, the problem is the tourist traders who have a herd mentality, they don't understand that. They don't understand that it's rigged. They don't get that. Now, here's another thing that confuses people during earnings season. They don't know what institutional money carries. Why am I talking about institutions? Because institutions, they're always right. They're never wrong. You've got to follow them. And how do you follow institutions? Through yields. And I'll talk about that a little bit later. So back to what's going on. So when people hear liquidity, they have wonderful liquidity. It's not cash. When they're talking liquidity, oh, that's good. They got a lot of liquidity. They got a lot of cash. No, that's not what they're talking about. It's not cash. It's access to cash. That's what's important. And there's 5 components that make up this liquidity, which is access to cash, not dollars. And the 5 components are bank reserves at the Fed, reverse repo money, the Fed balance sheet, Treasury issuance, bills, and credit conditions. So those are the 5 components that are what we consider liquidity, not cash. They want access. In other words, again, liquidity is not cash, it's access to these components. So that's another thing that most traders don't understand. Now, what institutions are really concerned about is how fast these 5 components can move through the system. So think of it as water, okay? So when these 5 components move fast, think of it as water, then credit spreads tighten and stocks will rally. And institutional money, again, doesn't care about cash. It cares about access to that cash. And again, liquidity. So you remember next time you hear that word, liquidity is bank reserves, reserve repos, Fed balance sheet, and Treasury issuance of Treasury bills, So that's all they care about. That's all that matters to the institutions when earnings season comes. They don't care about bottom line, top line. They could care less because it's all phony. It's all rigged. So those are some of the things that will help you as a trader when you understand, okay, these terms. And they throw these terms out to confuse you. So the next time they have a lot of liquidity. People, boy, they got a lot of cash. No. It's how fast those components move through the system that's important to institutions for them to go and buy those stocks. And that's how it works. So again, and we always go back to the institutional money, because institutional money is everything. That's how you make money in the stock market, following them. They're always right. They always know what's going on. They always know that when the market's going to correct or going to have a crash, they always know. And so that's why what ties you to them is watching the yields, the bond market. That's what it's all about. The bond market is everything, okay? And the institutions are tied to the bond market. So when they see declining yields, investors, the institutions, when they see yields going down, like look what happened February 9th to where we were today. Finally, we hit a bottom support at 4% on a 10-year yield, right? But investors, when you have a declining yield, investors feel, okay, we're going to have a very weak economy. So again, when you go look here, we just go look at the Treasury here. We'll see. Let's pull a 10-year Treasury up. I'll show you what I'm talking about. That's why we live and die by the 10-year Treasury. You see the severe collapse in the Treasury, that right down to 4%? Well, the bond people are in there buying bonds like crazy because they don't want it to fall below 4%, because that would be a travesty. You see this market really break. Because remember, they don't want to see yields declining anymore. Can you imagine if they declined below 4%? And I mean that would be, because here's what the bond market's telling you. Remember, the bond market, when you follow the institutional money, because they're following the yields, they're following the bond market, and when the yields start going down, the institutions look at it as, okay, we got a weak economy ahead of us, no matter what they say on TV, on these financial shows. So we're expecting a weak economy. So when yields are going down, the institutions then say, oh, I get it, we're going to have a weak economy. And that's what was happening all the way down from February 9th. And so And so what happens, investors the institutions start selling stocks. They start moving into bonds. So when you have a declining yield, investors expect weak economy because you always look forward. And the institutions, okay, the big banks, pension funds, hedge, they start dumping stocks and they start moving into bonds. So see, when you know how to follow the institutions, you're going to be with them. They always smell out if there's going to be a correction or a crash way before it happens. They don't run around going, what do you think the market's going to do? What do you think the market's going to do? They know. So during these weeks from February 9th, going down to the other day, this market had a cloud over it. And one of the biggest things that take yields down is when they start talking about rate cut expectations. That's one of the biggest things that can hurt the market when they go, oh, we're going to have rate cuts, because what happens? The yields will decline. That means you got lower wages, right? And that means you're going to have slower spending. You're going to have a slow economy. Like right now, they're telling people we're going to have a 5% GDP. No, we're not. It's going to be 1 to 2%. They keep reaching back instead of forward. They keep looking back in the rearview mirror and say, yeah, but look at the third quarter here. We had a 5% GDP in 2025. Oh, we're going to have a 5% now. No, we're not. We're not going to have that. So the other thing is we have a weak dollar. So when you got yields declining, you have a weak dollar. And what puts more pressure on the yields to go down, and why the institutional money, okay, is going to dump stocks and buy treasuries, is because that declining dollar, the foreigners love that, because now they can go and with the exchange rate, they can go now and buy dollars, get rid of their euros, buy dollars, and what do they buy? Bonds, treasuries. So you get the yields moving down even further. And that's why you saw right here, and you can see it if you go look at the treasury here, the 10-year treasury, I'll just put it up to date. You can see how the support is at 4.04. You can see how they've been pushing up ever since. They don't want that to drop through that 0.404. That support is key. If it breaks through there, you're going to have, again, a big drop in the stock market. So they're preventing that by now buying bonds. Now, so as I said, when your yield goes down, your dollar goes down, and then the foreigners buy dollars and they buy treasuries. That puts even more pressure. So it's hard to get out of that. So you got to get yields going back up. So when you're trading, it's all about yields. It's all about the institutions. When you follow the institutions, you're going to be just fine because they're never wrong. But most people don't understand when they hear the term, follow the money, follow the money. They don't understand what that really means. It means follow the institutions. Where do the institutions go first? They go right to the bond market. If the yields are going down, what do the institutions do? Dump their stock. They start buying bonds. So anytime when you're trading and you look over and you see that bond market and you see the yields declining, that the big boys who run this whole market, the institutions, the hedge funds, we talk institutions, we're talking hedge funds, we're talking the 5 biggest banks. You're talking, all the big pensions, all the big boys. You're really talking the cream of the cream. So, again, now, as far as what about yields, trying to get them to go higher, now, the reason for them to go higher is the problem with them going higher. You have the tariff court decision worries. You have tariff unrest. So you have geopolitical issues, like right now with Iran. So that's why you're starting to see, notice how the yields start going up a little bit off that base of 4. Now, a lot of that is fake because they go in and they buy in bonds because they don't want the bond market, the yields to drop below 4% or the market will go down big. But the other thing is, what are reasons for higher yields? Well, the court decision with the tariff unrest, the geopolitical issues with Iran, all that sort of stuff. So when you really look at the market, it's all institutions and it's all you. Once you know how to do that, you're in good shape. So why don't you come to my webinar this coming Saturday, $100, noon to 3 p.m., and it's all archived for 2 weeks.